Welcome back to What Would It Cost? On today's episode, we're talking all things private lending with our special guests, Carmine Scalzi, Gary Caplin, and Krystian Catala. Welcome, guys.
Thank you very much.
Thanks for having us.
Yeah, no, thank you for coming out. We know the three of you are extremely busy, so it's awesome to have you all sit down. So before we get into talking about private investing, private borrowing, tell us a bit about yourselves.
Sure. So I've been a lawyer since 2006. I've been a litigator, and I specialize in all things mortgages. We've done a lot of cases, a lot of interesting cases involving mortgage law, which is especially relevant now given the climate of the real estate market and interest rates going up. So we see a lot of interesting cases. I opened my firm back in 2016, and we've been specializing specifically in mortgage law since.
Awesome.
Yeah.
Yourself, Gary?
Well, like Carm, I'm a trial lawyer. I'm a commercial litigator. I'm a partner at a firm called Mason Caplin Rohde, and I've been doing this a long time. And I'm also a mediator, arbitrator, and I teach law at Osgoode Hall Law School.
Amazing.
I'm a mortgage broker. I've been doing it for just over a decade now. I've been in finance for longer. I've worked bank before that. Man of many hats. Was a chef for a while. Then, got sick of it and had family. It was like just too much, and got back into what I know, which is mortgages. So
Awesome.
yeah,
Awesome.
doing what I love to do.
Exactly, just like all of us.
Exactly.
So, the main question we get all the time is, what is private lending? From a lot of borrowers, I feel like there's a big negative connotation across the board with that. We talked about it before, what happened in the 70s and the 80s with private. So
40s.
So I feel like, and obviously we all feel like it's a great tool for clients in certain situations. So why don't we speak on that first for the viewers that don't understand what private lending is?
Well, essentially you're borrowing from a non-institutional investor or lender. It's such an interesting area of law because it's a double-edged sword. There are so many people that can't get approved given the criteria that the institutional lenders have. It's very difficult because, as you know, the application is rolled into your income. Mm-hmm. And given the value of real estate, it's very difficult for a young couple or people generally to get approved for the mortgage they need to close. Right. Private lending is, like I said, it's a double-edged sword. On the one hand, it gives an opportunity for a lot of people who couldn't otherwise afford a home. It gives them that opportunity. The challenge is it's a higher interest rate, right? We all know that interest rates effectively are a reflection of risk. Private lenders, generally speaking, are on the higher end of the spectrum because often you'll do second mortgages, so on and so forth. Not necessarily you can do a first mortgage as well, but generally it's higher interest, and you have to be careful, especially if you're borrowing. If there's a default, generally speaking, private lenders can be maybe a little more aggressive than your institutional, and you want to make sure you know what you're getting into before you get a private mortgage.
No, I think that captures it well. I mean, on both sides of the spectrum, you have borrowers who are in need of money, and sometimes, as you say, they're either they don't qualify or they want to stay away from institutional lenders. For the investor in mortgages, great opportunity. Interest rates are what they are. I can't recall in the 43 years I've been practicing law when there's been so much private money available for lending. And you really need to know what you're doing, both as a borrower and as a lender. As Carmen says, you need to understand risk. And here's where the professionals come in, particularly your mortgage broker, if you have one, and lawyers, if you have one, a real estate agent, if you have one. So you really got to know what you're doing.
100%. That's the one thing I suggest to everybody. Like, make sure you hire a good mortgage broker, because that's the difference right there. Like, there's some mortgage brokers that don't care about anything except making that money in their pocket. So they'll go to their client, let's get a private mortgage. Don't worry about the bank. Let's get a private mortgage. Just get it done quick, even though they know that they're over leveraging the client. The client can afford it, and the next step would be a foreclosure.
Right.
The proper advice would be, listen, you're done. This is you've reached the max point. You can you're over leveraged. You got to sell, and that's it. It's not always about making the money. It's about advising your client.
Right.
Your rule of thumb is typical 1-year terms. I remember, right, when you were training us and you put us on, I tell everyone, and I continue to, you don't want to be in there for longer than a year. You want to keep that LTV lower so that everyone's sleeping at night, and you want it to be that, you know, you see these payments made on an ongoing basis as opposed to a prepayment, because it has it being that it's a better look and it looks like the client's in a good position and can actually afford it, right?
Exactly.
But I remember the one thing when filling out the applications and talking to the client all the time that you trained us on was how they're getting out. How they're getting out, who's taking them back to the bank, how are we getting them refinanced. You have plans to sell. If they have plans to sell, leave the term open and don't lock them in, right? So you had a lot of etiquette in the private space. And I feel that there's more and more brokers that are working with gentlemen like yourself that are bringing a good name to the private market for investors that get a secured investment with a solid yield on an overall, right? So
because lenders will generally look at two things, right? Generally speaking, one is the covenant. Does the borrower have the job, the resources, the money to afford the monthly payment? Is there going to be an interest reserve or not? And the second aspect that a lender will look at is the equity in the property. If all else fails, will there be enough LTV, loan to value? So if the borrower can't make it, will I be able to sell the property and get my money back? And that includes the transaction costs. This is where Carmine and I would come in. You know, what's a lawyer going to cost? How long is it going to take? What's going to be the return?
Yes.
These are all the unknowns. And that's why, back to your point, you discuss these things with your broker. Always, you know, it's always easy to think about how much money am I going to make on a mortgage. But you also have to ask yourself, what happens if it doesn't work out? How much time is this going to take? How much money is it going to cost? And what will the result be?
Right, absolutely.
Well, just to add to that, you know, Nick, you made a point earlier about most of these private mortgages, the vast majority by far, are 12 months.
Yeah.
And this is, again, two sides to the same coin. On the one side, from a borrower perspective, you're borrowing this money. You've got a 12-month term. Almost no one thinks about what happens when the mortgage comes up for renewal or expiry.
Right.
Okay. And so often what happens is they find that the term expires and something has changed in the market and they can't renew. They can't find another mortgage. Okay. And as a result of that, they're stuck in a position where they've got a mortgage now that has expired, which in legal terms means it's in default.
Right.
And there's legislation, specifically the Mortgages Act and the Interest Act in case law, that talks about what rights the mortgagee, the lender, has in that circumstance. And as most people know, of course, there's essentially two avenues. One is called foreclosure. Another is called power sale. 99% of all mortgages in default, the lender opts to do a power sale. And perhaps I can give a quick distinction between the two. Very simply, a power sale allows the lender to commence an action against the borrower to get a judgment in court so that they can, in the end, sell the property to collect what they're owed on the mortgage. A foreclosure is structurally different. In essence, and Gary, you may have a better way of describing it than I do. In essence, when you go to a foreclosure, what you are in essence doing is you're giving up your mortgage for ownership of the property. So in the end, you no longer hold a mortgage, but you own the property.
Well, the good thing is that in the mortgage document itself, the lenders are given certain contractual rights to sell the property. They have the contractual right to take possession of the property. And they also usually, at law, have the right to foreclose, which is a totally different remedy.
No, and I love that. And I love the distinction between the power sale versus foreclosure, because a lot of investors as well, that's what I was looking for. You know, the ROI sounds great. The loan to value sounds great, but what's my risk?
Exactly.
So we're going to take a short break, but when we get back, we're going to talk about becoming a private investor.
Escaping the concrete jungle to cottage country is high on the wish list for many Canadians. SparkFinancialGroup.ca is here to help you secure the best rate on your mortgage for a waterfront home or countryside dwelling. Spark Financial Group, where finance creates freedom.
Welcome back to What Would It Cost? Today we're here with Carmine, Gary, and Krystian, and we're talking everything private lending. And not only are we going to hear from the experts in regards to what the rate of return is and what that looks like for investors and borrowers, but also how you can stay protected as both a lender and a borrower. So take it away, Krystian. Let us know how sexy it is to invest in the private market.
Super sexy stuff, man.
I'll put it this way, it's as sexy as Gary.
And you boys let us know how
Sure.
safe it is when you guys come to the
Yeah, go ahead. Mock the afflicted. See if I care.
So I want to keep it as simple as possible, actually. So let's take $100,000. Let's say Mr. Smith has $100,000 sitting there. And he goes, I'm not making enough money on my mutual funds or whatever he has invested in. So he comes to me and goes, listen, I want to put it in mortgages. So this is our process. So I go, okay, Mr. Smith, no problem. Here's our intake form. So we actually have a form we fill out with the investors to make sure they're suitable investors. So like the number one thing we're going to ask our investors, if a year from now something were to happen with this mortgage, could you afford to like wait another 2 months to get paid out? Or is it a dire hard, you have to have it then and there? Or say they don't make the payments. Is it die hard that you don't get the payments every month?
Are they relying on it for cash flow?
Exactly.
And that cash flow is supporting their lifestyle. So you want to know that.
So if the answer to that is yes, then they don't qualify automatically.
Okay.
So
what do you tell them if they don't qualify?
I'm sorry.
Isn't it embarrassing? Sorry, you can't invest in a mortgage. Right?
Yeah, that's what it comes down to basically. It's not right for you.
Don't put yourself under that pressure if you don't need to.
Right.
And so what is that $100,000 investment?
So $100,000 investment right now in today's market, we're paying, you'd see a monthly check.
Yeah.
$100,000, you get a monthly check for $1,100.
Okay. So $1,100 monthly, and that's interest only, right?
Correct.
And they receive their full principal at the end of the 12 months. So that $1,100 is net profit, which means at the end of the year, they're earning around $12,500.
Yeah. So So we're saying 12 to 13% we're paying on our second mortgage right now, right?
Okay.
So minimum 1,100, could be a little bit more if we do 13, right? So
right.
And that's it. No cost to them. The borrower pays all the legal fees. The borrower pays for everything. Even if you're doing an e-transfer or a wire transfer for that money, we charge the $30 wire transfer fee to the borrower as well.
Yeah,
Every cent is charged to them. You don't pay $1.
Right.
So in the sense that there is risk, the investment's great because no one else is paying right now that kind of ROI on anything right now, especially in this market.
Right. Yeah.
You've seen the stocks, you've seen crypto. I had crypto. It took a beating. So
I hope you didn't have anything in FTX. That was
none of that.
Yeah,
But
that's very interesting.
Even I have great crypto, but even those they all took beatings right now. So like the market's down, the crypto market's down like 30%, 40%, if not more in some of them, right? So this is a safe bet in this market. A lot of people looking for money. As long as you're very safe, you associate yourself with a good broker, a good lawyer, and you're very cautious, you're good. Like we check our appraisals, we order appraisals from our own appraisal companies. So our appraisals are always current. If you bring me an appraisal for a month ago, 2 months ago, good for you. I want a new one from my company.
Yeah.
I choose, not the company you bring me.
And you warn them that an appraisal is a snapshot of time, of value,
100%.
but it's based on history. What some people forget is an appraisal is good for now, but will it still be good a year and a half from now?
Even 6 months?
Or even 6 months, because markets go up, markets go down.
Yeah, this is why.
And again, you have to understand the risk of the market.
Right.
And predicting the market, that's another science in and of itself, or an art.
100%.
Also on that, I find that the one of the most important things that the borrower or the lender is relying on with the appraisal has a lot to do with making a bad investment. Just like you need a good broker, you need to have an appraiser that either your broker is recommended or comes highly recommended.
Right. I think even for the borrowers, because the conversations we're having most lately now is that, I thought it was worth $2 million and it's coming back at 1.6, or I thought it was worth, but I always explain to them, just to switch the negative on, is saying like, let's take it for a grain of salt of what it's coming back at, because okay, let's say it is $2 million and you want me to give you the 80% loan to value on that $2 million, you're going to be the one that's stuck later on.
That's right.
Even the borrowers have to understand that, yes, it's the appraisal to protect the investor, but I think also to protect them, because you don't want to over leverage. Yeah, I'll find you the person that will give you maybe a little bit more for a little bit of a higher rate. But going back to the exit strategy, how are you going to get out after?
That's a great
Especially
point.
when the bank,
You're stuck.
where that person is, they don't care. It's their appraisal or nobody's appraisal, and that's it.
Yeah.
Well,
unless it's going to be, the funds are going to be repurposed and invested like a construction financing loan, right? This product's very popular for them because there's not all the hurdles that the banks put in front of them, and they could boogie when they got the capital behind them and start to turn profits when they put these houses up. But if these are homeowners that are putting a second on their house behind, a big first already, it's very unlikely that someone's going to be able to just find $100,000, $200,000, $300,000 with what they've done throughout that year to pay it off. So it's got to come from a refinance or a sale.
Yeah,
gotta
but
make sure that
and then borrowers say, okay, I'm going to take out a second, and what am I going to use the money for? I'm going to improve my house,
Right.
and therefore it'll be worth a lot more in the future. Well, it may not be worth a lot more in the future, and what you're spending the money on, will it actually increase? The curb
Exactly.
value of the house or the attractiveness of the house later on. You have to think through exactly, why am I borrowing on a second, God forbid, a third, and even ask yourself, am I going to see that? Is it going to be in the bricks later?
What's my ROI on borrowing?
Exactly.
Yeah.
There you
Exactly.
go.
Yeah.
That's a good way of thinking about it.
We did one once. A guy took a second. Obviously, we wouldn't say a name or disclose a property or an area, but a guy took a second mortgage for a couple $100K, right? And it was for renovations, right? And he did. He was gonna
gutted
renovate it, but he had some bad habits, right, and some vices that his capital was able to really power up and bring back his past. And he spun out. For 6 months. He went on a binge. He went wild. It caused a full-blown divorce. He was kicked out of the house, and he had done a couple trips to Vegas. He had really
Hey, does this sound like anyone we know,
he had
Gary?
really went off,
Right?
right? And it came down to a point where, again, the way we underwrite it, there was lots of equity there, but there was no way that he was going to be able to pay this off. And like you said, he didn't renovate the house, so he didn't bring that value up, and it had to sell, right? Yeah. But he had a solid time for 6 months.
Maybe it was worth it.
Yeah, and to go to that, because we were talking about it a bit earlier, maybe explain the reason for the holdback. So to go to Nick's point, especially with construction finance, and they want to do it in tranches where it's like, okay, what's the next step? This was a small amount, so we just issued the full amount. But again, look what happened. Whereas if we held back maybe a little bit, maybe actually would have finished the foundation of the property.
Homeowners who borrow money to improve often don't think through what that means. So ultimately, there's a statute called the Construction Act, and there are certain requirements about holdback and other things that can, if you're not savvy enough, you can run into trouble on your house. The worst thing that you want to have happen to you is, you miss a payment on your mortgage. Okay, that's nice. But what happens if you don't pay your contractor because you're in a dispute? They file a lien on the property.
Which is in default of the mortgage under the terms.
Which is maybe an automatic default of the mortgage, and the mortgagee then cannot advance another more money because the lien is in the way. It's a priority fight. Again, homeowners may not, even though they think it's a simple reno job, I'm just putting in a new bathroom or putting them in, but I'm hiring a contractor to do this. You got to think this through. You have to know exactly what you're doing and what could happen if things go,
and what
sideways.
contractor you're hiring as well, because I've seen contractors try to take the clients hostage as well, right?
There's a lot of
so you got to be careful,
contractors.
like what you just said about the liens. There's been contractors. I've had a client. His contractor put a lien on his house, didn't do any work, just because he knew he could use him for money.
Right.
Jeez.
Yeah.
And the client had no choice but to pay him the $60,000, because if not, he couldn't finish his house. So he had to pay him. They're going to court for it now, but the guy took out for $60,000.
Right.
Yeah.
And also on that point, there's law as it relates to construction liens, and most lenders don't know that. They think if they got a first mortgage on a property, they're in first position. Not necessarily. There's a test that's set out I think it's not codified in the Construction Act. I think it's just case law that talks about certain situations when a lien claimant who registers a lien 6 months after a mortgage, even longer sometimes, can claim priority over the mortgage.
Right.
Mm-hmm. Right. And there's a whole legal test. Gary, in fact, knows the test better than I do. But it's an added risk that lenders have to keep in mind. And I want to go back to a point that both of you made about this. What happens at the end, and you perhaps, as the expression goes, be careful what you ask for. If they go out and they apply and they get a mortgage and a second mortgage for an amount they can't afford, at the end, if there is a default. And remember, the definition of default, there's many different definitions. A classic one is you stop paying your mortgage payment. When the mortgage comes up and expires, that's a default, amongst other things. If you're insured, it depends on the Schedule A that you sign, but generally speaking, if you're not paying your insurance or taxes, that's all a default. So what does a borrower do in that situation? If they've borrowed too much, this is not rocket science when a mortgage goes in default. As a borrower, you have two simple options. You mentioned it earlier. You refinance or you sell. And if you borrow too much, what most people don't know, most lawyers do, is a lot of times the homeowner goes out to try and sell.
Right.
Well, if they get an offer that they accept that is less than the amount required to pay out the mortgages, the mortgagee, the lender, does not have a legal obligation to discharge unless they get 100 cents in the dollar. So we've had so many cases where borrowers, and I strongly recommend this in the right circumstance, will go out and get an APS, agreement to purchase and sale, unconditional, quick closing date. That's terrific on one side because it stops the bleeding. You see, once default happens, that's when all the fees start to really incur and accumulate on your mortgage, legal fees and so on and so forth. But the problem is that they secured it, they didn't get the proper legal advice, and now they're sitting there with an accepted agreement of purchase and sale, and the second mortgagee saying, no, I'm not getting 100 cents of the dollar, I'm not discharging. Right. So now this borrower has just introduced an entirely separate piece of litigation because the purchaser on that APS is going to sue to try and get specific performance, which is to force the deal to close, which they won't get because they're not going to get clean title. But they've attracted another lawsuit in addition to the default in the mortgage. So you really want to start at the end and work backwards. You want to take the worst case scenario as a borrower and say, okay, if I can't pay this mortgage upon expiry, I need an exit. And that exit is either a refi or a sale. And if you do a sale, it's got to be for an amount that's going to cover the mortgages. So at the very least, you want to have that in mind. And
I think the word, just building on that, Carm, I think if you're someone who's interested, as an example, borrowing money because you want to renovate your house, right? You go to your broker, tell your broker why you want to borrow money, and then get legal advice about all your obligations and risks going forward. And that includes the Construction Act and lien claims and what happens if this happens. Unfortunately, people tend to go to their professionals, lawyers, when problems arise. Understand what you're doing before you borrow the money, have a plan. Know exactly how long things are going to take and what happens, back to your point, Krystian, and back to your point, Carm, what happens if things don't work out the way you're planning? What are my rights? What are my remedies?
Right.
Get advice. Just don't get it from Gary, right? Gary?
Yeah.
Well, you can, but I may charge as much as you do.
Hey, Gary charges by the letter.
Nothing wrong with that.
It all goes down again to having the right professionals with you. Like you have to have the right team behind you. Like if you don't,
at the beginning, not at the. I mean, at the end
obviously
too.
From the beginning to end, you got to have the right team.
Yeah.
Right broker, right lawyer.
Yeah.
And be honest with your broker. Tell the broker what is it you were going to use the money for? What's the idea? What's the plan?
Yeah.
Because the brokers they're specialists in this. They're not only putting borrowers and lenders together, they need to know the big picture.
Mm-hmm. Yeah.
There's one other point I want to add, and I see it so frequently now. Lenders are becoming much more sophisticated, and one of the clauses that is so intriguing from a legal point of view, I won't bore you with all the details, but it's this renewal clause. You see, there's legislation out there designed to protect the borrower, specifically the Interest Act. And there's a Section 8, I believe, of the Act that talks about what a lender is allowed to charge when there's a default. And what most private lenders don't realize is these penalties, is $100 or $1,000 a day default fee, even NSF fees. There's some exceptions to that. But in essence, the general rule is when a mortgage goes in default, as a lender, what you are allowed to charge is principal, interest, and reasonable, emphasize the word reasonable, out-of-pocket expenses that are necessary to enforce the mortgage. Okay? You can't charge all these arbitrary fees. This renewal clause is a very intriguing one because on the one end, it's in violation, depending on how it's drafted, it's in violation of the legislation, but if drafted in a particular way, it gives the lender the option in their discretion, at their will, to renew or not. Right. And so often we have borrowers and lenders come into our office, but borrower will come in saying, well, look, we got a letter from the lender. They decide to automatically renew. And there's X points that are added to that, 2, 3, 4, 5 percentage points that they charge as part of the automatic renewal. And the borrower wants to get out of it. But because of the way it's worded in the Schedule A, they can't. Right. And the lender's allowed to do it. So again, to Gary's point, he's made a very good one. You want to make sure you get the advice before there's a problem, not after.
Yeah. And to go back to that, working with a good broker will have this whole ecosystem set up. They'll have an awesome appraisal. appraising company. They'll have awesome lawyers that are backing up their clients, whether it's a lender or a borrower. And I've seen you build people's wealth up real big, right? And in their retirement, they come to you with, they start off with something, and I always have seen them grow it and grow and grow it, where you facilitate millions of dollars for people and you help them build real wealth through passive income that is interest only. So you got the right ecosystem, you got the right team on your side. This is an awesome way not only to secure your investment, but to make an amazing yield.
On that note, there even like RSPs, there are people with like millions of dollars in RSPs making nothing right now.
Yeah.
We do a lot of RSP mortgages.
Yeah.
So there's certain companies that we use, and we just basically, it's just like a normal mortgage, but we get it to your RSP, and the money goes back into your RSP. Now, whose RSP is making 12, 13% right now? Nobody's.
Yeah.
No, not mine, I can
Mikey
tell you that.
always says that because Mikey's got the financing background as an advisor at the bank. He's always telling people about the RRSPs and about their savings and their checking
Even
accounts.
TFSA,
And
not
just
TFSA, exactly.
really not being able to.
Tax-free on 1% is nothing.
Yeah.
And how many, and a big reason too why we wanted to do this segment and this piece is how many people, how many billions of dollars are out there stuck in these accounts, and people don't know how to leverage that capital and maximize the potential of the yields, right? So we're trying to raise awareness for that and say, give us your money. We know what to do with it. There's a solid team that has your back, and we'll help you build wealth.
On that note too, so I have a lot of our friends, what we've done with them is, yes, interest rates are high. So yeah, your line of credits are, say 5-6% right now.
Yeah.
So our friends have taken line of credit on their houses. Most of them have no mortgage anymore, very small mortgages.
Yeah,
I know. Get the line of credit, you're paying 6 points, but if you're getting 13% return on that money, your spread's 7 points still.
Exactly.
Right? Your house is making you money.
Yes.
Yeah.
It sits there and makes you nothing, or you leverage it and you make money with it.
That's the old school mentality. We're trying to get a lot of people out of that. Mortgages doesn't equal bad.
Yeah.
Mortgage equal good.
Because line of credit,
in the simplest terms.
Line of credit, you pay as you use
that
it.
asset. Exactly. Use that asset to increase your wealth exponentially.
Leverage.
Yeah.
Leverage.
There you go.
We teach them how to
Leverage is
Right
good.
there.
Leverage can be very good if
All
done
day.
properly.
Yeah.
All day.
Perfect. Well,
and you always talk to people about the HELOCs, Mike, the home equity line of credits, because whatever we're paying on it and whatever you can get them in regards to the rate of return on a private, you're making the spread.
Well, if you leverage to go to Vegas, I don't think that's a good idea, like your buddy did there. But that's an example of bad leverage, right?
exactly.
Well, bad, I guess, but it's good for those 6 months while I leveraged it.
Exactly.
But
Exactly.
And just to go back, on some bad math that I had, it was 13,200 with that rate of return.
There you go.
12%. I was off by 7, and that was bugging me all up.
No worries.
it's okay.
Well, thank you guys so much for taking the time again to sit with us today. We really appreciate it. And thank you everybody for tuning into this week's episode. We'll see you next week. Coming up on What Would It Cost?
So just to start you guys off with why pre-construction, mainly me working with a lot of first-time home buyers and investors. One thing I like to point out is in this transitionary market, previously, pre-construction, it was very difficult to have that full experience, that client experience, which I like to give to my first-time home buyers. So what we saw during that hyper market was people had to act very fast. And so they didn't get the full experience, whereas now you can take them to the sales center, they can choose their floor plans. So just right off the bat, my first-time home buyers who are considering, especially condos, they get much more of a 5-star experience with pre-construction. And another big thing too is right now the builders, they have to get creative, they have to get innovative because there's so many projects coming to market. Last year when there was a crazy market, they didn't have to be innovative because they would sell out so fast. So I think why pre-construction now is because you're getting so much more out of these projects because they're so innovative.
You don't need to come up with a huge deposit up to 20% within 30 to 60 days of purchasing. Right. The beauty of pre-construction is that your deposit structure is amortized sometimes over 2 years in smaller chunks and smaller increments. So it allows you to save that money and put it towards your initial total deposit without having to necessarily close or register a mortgage.